Hey, it's Justin Harvey. Thanks for tuning in to the Anesthesia and Pain Management Success podcast. With APM Success, we take a close look at important topics pertaining to business, practice management, personal finance, and careers for anesthesiologists and pain management physicians. We work hard to take your critical questions straight to the experts. Thanks for listening. Hello and welcome to APM Success. Happy tax season, everyone. I'm here with my friend, Evgeni Ivanov, friend of the show, and our resident tax expert. We're going to talk about some low-hanging fruit checkpoints on your Form 1040 and accompanying schedules to just make sure that your taxes are squared away and you can keep your tax preparer honest to make sure they're not making any stupid mistakes. Evgeni, welcome.
Thanks, Justin.
So for anybody who is listening audio only, I'm going to share my screen a bit, and you can check out the YouTube channel if you haven't already. You can subscribe in the show notes, where we're going to do a bit of a visual presentation, walk through a couple of these tax forms. As always, we're going to try to keep this short and punchy because I know taxes are not everyone's favorite topic, but it is a really important one for our attending physician clients. Taxes are going to be your biggest expense for the next couple decades, so it's good to be a little bit informed about them. And we're also going to look at a couple of sort of classic planning opportunities, questions, considerations for physicians and high-income households. So I'm going to flip over to the Form 1040. And the first I want to point out is line 4 on the 1040. So the 1040 is the main form for a personal income tax return. And I'm looking at the 2023 form here. For IRA distributions, line 4A and 4B, one of the classic opportunities for our physician clients is the backdoor Roth IRA contribution. Obviously, if you're making a lot of money, you can't put money right into a Roth IRA. So you've got to use this two-step process, which the IRS has recognized implicitly as something that is illegal. You could call it a loophole. It's just a method by which you get money into a tax-free account. So Evgeni, talk a little bit about lines 4A and 4B and what a taxpayer should be looking for here if they're doing a backdoor Roth.
Yeah, thanks, Justin. I like the definition of a loophole. I know certain congressmen want to close it, but as of now, it's still open. I know they tried a few years ago unsuccessfully. So basically what line 4A and 4B are is how much did you receive, or more correctly, how much was reported to the IRS as a distribution from your IRA account. Line 4A and 4B is how much of it is taxable. When you do a backdoor Roth IRA, the way it works is you contribute money to an IRA. You are an advisor at that point who's managing your IRA account, turns and contributes that account, the money right away to a Roth account. But when that happens, they need to issue a Form 1099-R, which is reported to the IRS. And if you're not careful, if you're preparing your taxes by yourself or you don't inform your CPA what the form is about, it can end up being reported for a line 4A and 4B, which makes it taxable. So you pay taxes on it, although you didn't receive the money. It's sitting in your Roth IRA account. And that's why it's important to review taxes, ask questions, and give as much information as possible to your tax advisor.
Yeah, and this is one of these areas actually I see commonly. Maybe, Evgeni, you field some of these questions, especially my clients and friends who want to self-prepare. I find that TurboTax is terrible at handling the backdoor Roth and the 8606, which is the form that reports the non-taxability of the backdoor Roth IRA contribution. And what I often see is IRA distribution, $6,500, taxable amount, $6,500, and there's not an appropriate input place, or at least not one that users can readily find, that will make the Roth contribution non-taxable. And you end up getting double taxed on that money, which is not what you want. And it makes the backdoor Roth not work for you. So check out 4A
as the
and 4B.
penalty.
Yeah, go ahead.
Yeah, don't forget the penalty of 10% if you're younger than 59 and a half. So it's not only taxed, it's not only taxed twice, it's also penalized. So it's more than taxed twice at the end.
So yeah, check out line 4. especially if you're self-preparing, frankly, this is like one of those things that if for no other reason than this will be handled correctly, it's not a bad idea to get a tax preparer to help you with this one. The second line on the 1040 I want to point out for just a spot check for our listeners is line 7. If you're somebody that has a taxable investment account. So a taxable investment account is a brokerage account that has no inherent tax advantage, but it does have taxable activity when you buy or sell, if you realize losses or gains, if there's taxable distributions from this account, from the holdings within the account. It creates taxable stuff happening. And if you have a big account, one of the benefits of working with an advisor who is proactive in investment management is tax loss harvesting. So one of the things that we do for our clients at APM is to, whenever holdings go down, if there are losses that are not realized, we sell the security, we buy a substantively similar security, so we maintain consistent market exposure, we lock in that loss and offset some current income in the current tax year. This would show up on line 7 of the 1040 and Schedule D as well, which is one of the supporting schedules. So if you've got a bunch of taxable assets and you're either reporting big gains here, if you're reporting big gains or not reporting losses, I would point out, 2023 was a great year for the stock market, up 20+% for the S&P. 2022 was way down. Great opportunity for tax loss harvesting for many of our clients that had taxable losses. We were harvesting in 2022, and we're going to carry that forward into the future. So take a look here and see if your advisor has been doing their job or has been doing something in the background in terms of tax loss harvesting in that investment account. Evgeni,
I will
anything to
go
add
one
on this
step
one?
forward. Yes, I'll go one step forward, and I will even say sometimes it's worth even doing it if it's a bad year or you have some of those investments. Sell them now, even if the loss will be disallowed in the current year. But if let's say next year, you're expecting a big gain, could be from a sale of business, sometimes from, let's say you inherit a house from your parents that you and your siblings are selling and you're splitting the proceeds, although those chances are they're not going to have a gain if the step up stays as a law. But it can happen. Certain investment properties, anything that's of, and you have the losses now that are not guaranteed to stay, just sell the losses and keep them for the future years. And it will decrease your taxable income next year or the year after that, whenever you have the gain.
Capital losses can offset up to $3,000 of ordinary income in the current year. So that's one of the benefits of locking in these investment losses is your earned income goes down by $3,000 and the remainder, I like to call it the reverse piggy bank. When you lock in those losses, you carry them forward into the future so that if you have capital gains in the future or more earned income, as you'll probably have both, they don't go to waste, as Evgeni is saying. So that's number 2, line 7. See if you have a capital loss in terms of holders of taxable investment accounts. The next one I want to look at is looking at your total effective tax rate. So what percentage of the money that you earn is going to Uncle Sam? And we're going to talk about just federal here for our purposes. But line 24 divided by line 15. And I'm going to flip over here again. So line 24 in the tax and credits section is the total amount of tax paid, the total federal income taxes paid, divided by line 15, which is the total taxable income. Evgeni, can you briefly describe how taxable income is derived?
Yes, so it's taxable income starts with income, as it says. Then you get to a point which is line 11 that says adjusted gross income. And that is for most of our clients, it's all their income. Then you have certain deductions that are allowed before the taxable income is calculated. Line 13 is probably the newest of them, which came with the Tax Act and Jobs Act. I messed that up. You see, I'm already forgetting how the abbreviation works. In 2017, that's 20% deduction of your business income. So everybody who has businesses that are separate tax returns, or even if they're not Schedule Cs, and they're not in certain industries that are disallowing the deduction, you get this deduction. Line 12 is either your standard deduction or itemized deduction that you can subtract from your adjusted gross income. Depending on the state and the situation, it's either one of them. And that's how, when you subtract those two from your adjusted gross income, that's how you end up with your taxable income. And that's the amount you use to calculate your tax.
So
now, there's different rates.
Yeah.
That's right. There's different rates that go into effect when you calculate the tax. And that's why Justin saying he wants to look at the effective rate, not just the taxable income multiplied by a certain bracket or anything like that, because those can vary.
Yep. And the more money that you make, obviously, you move into higher and higher marginal brackets. And what I find interesting is to quantify the effective tax rate, meaning like what is the percentage of all the money that is earned here? What percentage of that? This is what we would call the effective tax rate. Of every dollar that I make, how much is going to Washington, D.C.? And this is not as much of a keep your CPA honest as it is just a interesting data point to observe and absorb, and can actually impact something like should we be doing Roth conversions or something like that if you're approaching retirement and maybe have some lower income. If this is a lower number, if your effective rate is lower and you're expecting it to continue to be lower, it's there's some planning opportunity that can create.
This was probably what was used. I don't know how many of you remember a few years ago when it was all over TV when they were saying that Warren Buffett was paying less taxes than his secretary.
Mm-hmm. I remember.
That's the rate I think they were looking at. Yeah, because the secretary probably received a W-2 for her job and she paid ordinary tax rates depending on the bracket. And I assume, I don't know what Warren Buffett's income is, but most of it is probably capital gains or losses, dividends, stuff like that. Or maybe he had some loss harvesting that he did. And those have smaller tax rates. And I doubt he paid less taxes. It's just that his effective rate was way lower than hers. And that's what the outcry was about.
Yeah. So the final item I want to cover briefly is on one of the supporting schedules. And this is whenever you either move from self-preparing to working with the CPA or moving between tax preparers, there's a number of information that needs to be properly carried forward in order to make sure that you're not paying more taxes than you need to. And the one that I have found returns where this was omitted and that we left behind essentially a bunch of money for my clients, like in the past, that was lost and needed to be retrieved, was looking at Schedule D. So Schedule D summarizes investment activity, capital gains, and losses. And if you, as we discussed from line 7 of 1040, if you have more than $3,000 of capital losses in a current year, and you don't have capital gains that will offset those losses, then you're going to have a carry forward. So if I lock in $10,000 of losses, I use $3,000 to offset my ordinary income, and then I have $7,000 of losses that I have locked in that I can't use, and this becomes a capital loss carry forward. And this shows up on Schedule D in lines 15 and 16, and this needs to be carried from year to year. And if your CPA or your tax preparer is not looking at your prior return closely, there may be a capital loss that is not properly accounted for in the current tax year, and either income that you earn this year or capital gains that you have that should be offset by a capital loss are not, because of the lack of capturing this historical data on Schedule D.
To summarize in one sentence here, what Justin is talking about is if line 16 is negative, that means that you have capital losses for the year, which could be also from prior years because they're all summarized there. So if line 16 is negative, the amount that needs to show on your next year's tax return as a loss carrying forward will be line 16 minus $3,000 that was utilized in the current year. And if that number doesn't match, now it could be split between long-term and short-term. So you need to make sure you look at both items on the first page of Schedule D. If you scroll up, we can show which lines those are. There's special lines for carry forward. It's line 6 over here, and it's the same line down for long term. So when you look at those in the following year, make sure that the total of those is equal to line 16 minus $3,000. That's the easy way to look at those losses.
Thanks, Evgeni. So bottom line here for our listeners is there's a handful of these data points that it makes sense. I mean, I would recommend looking, even if you don't prepare your own return, look at least these items to make sure that your tax preparer has, in many cases, it's not that they were negligent. It's like, oh, there's a form missing or something wasn't properly flowing through in the software or just an oversight by one of their associates who's doing data entry or something like that. But these errors do happen. It does cost real money. So it makes sense to do just a very cursory due diligence check, especially in a year following a change, and looking at backdoor Roths on lines 4A and B of the 1040, looking at the capital gain on line 7 to make sure your advisor is doing some kind of tax loss harvesting if possible, to quantifying your effective tax rate, and to making sure that the capital loss carry forward that you may have had in the past on Schedule D, line 16, is preserved for offsetting your future income. So, Evgeni, as always, thanks for this quick primer on some important tax topics. It's been a pleasure chatting with you today.
Same here, Justin. Thanks for having me again.
If you liked what you heard this week, head on over to apmsuccess.com, where you can find more content and free resources to help you build a successful career in anesthesia and pain management. If you wanted to leave a review in iTunes, I'd also really appreciate it. Thanks for using some of your valuable time to join me today on APM Success.